Welcome back mindful investors. In this video I'm going to talk about my dividend growth portfolio, and today is February 25th 2021. The portfolio size today is worth about 450k, and I believe the last time we did this video was like 5 months ago. Let's take a look right here. This one, 369 dividend growth stock investing portfolio, road to $1 million. September 29th, so that's exactly 5 months ago. And the portfolio then was worth 369k. So if we do some quick math here, 459 minus 369, that's an increase of 84k for the past 5 months. But this 84k isn't all capital gains. It's a combination of a couple of things, as I shown in the previous videos. We're gonna quickly go through this again because we have a lot of new viewers. Okay, so here is account activities. Let's say from September 29th to now, let's see what happened. So parts of it is from my deposits. As I mentioned in previous videos, I make regular deposits every single month. Right here, if we just click on deposits, it shows 5 different deposits once every single month. Sometimes it's end of the month, beginning of the month. Sometimes I get ahead of myself and I say, oh, in the middle of the month, I'm gonna put it in anyways. But for the past 5 months, I deposited 5 times, 5k each. So my deposits here accounted for 25k of the 84k. Let's pull out a calculator again. So if we have 25 divided by 84, that's a good 30% just from my own money. But where is the other 70%? Where is it coming from? Well, this is the snowball effect. Well, this portion can be broken down into 2 parts. One part are the dividends I received. The other part is the capital gains of the stocks. Okay, so let's take a look at the dividends received for the past 5 months. Right here, it shows 46 different payments, and we see that some of my larger holdings will have larger payouts. For example, this World Bank right here, it had a dividend of $542. Right here, TD Bank has $561, and Bell Canada is $213. Canadian Natural Resources, $300. Fortis BC, $396. And then again with World Bank, TD, and so forth. So together, all of this, I'm not sure if I can get a total of all of this. It would be interesting if I could. Okay, we're gonna try tallying it up. We're gonna export to Excel and try to get a total number for this because I'm very curious as well. So let's take a look at what we have. Okay, export to Excel. There's downloads, activities, XLS. Okay, import data for the past 5 months. Let's take a quick look. I'd love to see it. Oh, I think I got it. All right, so I think this net amount. Okay, so all of these are dividends. 46 payments, right? Okay, so the first one is a different account, so we're gonna ignore this one. But the rest of it, we can sum up. Equals the sum of all of these, right? Okay. Sum of those cells, that's it. Oh man. Okay, I'm gonna copy it somewhere. I'd love to know what was happening here. I'm not sure why it's not working, but I'm gonna copy these numbers elsewhere and try it again because they all look like numbers to me. They aren't symbols, so they should add up. Equals sum of parts. Okay, sum of, oh my god, what the hell's going on? It's not the decimals. Okay, I'm not sure what to do now. Okay, so none of this works. I'm not sure why all these numbers are here, but I used the sum function. It should all work. I don't know why. I tried everything. I tried sum here. I tried pulling it out, and then sum here as well. It's not adding up. If any of you know how to do this, let me know. But now we're gonna do it the manual way. because I want to know the answer. So approximate, okay? We're not going to put in the cents. We don't care. So 20 plus 542 plus 562 plus 20 plus 213 plus plus 78. $6,358 of dividends over the past 5 months. There we go. And to extrapolate this number into a yearly dividends, we have to divide this by 5 to get the dividends per month and then multiply it by 12. Approximately right now, I'm getting $15,300 in dividends per year. Approximately. And why do I say approximately? Because there are different parts of this snowball, okay? So the dividend portion only accounted for $6,000. And I put in 25. We're gonna use a calculator again. 25 plus 6 is 31, divided by 84. That's 36.9. So where's the rest of the 63%? If we do the 1 minus, okay, and then minus 1, multiply that by the 84K, we have 53K missing. Where did it come from? Well, to find this number, there are different subparts as well. The main portion, I probably account for 90% of it, is from the banks. I think over the past 6 months, it's gone up quite a bit. So my two main holdings, TD Bank and Royal Bank, 3 months ago, it was down to about $61. Right now it's at 78, so that's about 30%. If we look at the Royal Banks of the world, it should be the same. It should be the same case. So around 6 months ago, it was $95, now is $109. So that's 18% or so. But there were some of these smaller cap stocks that I own. Right here, Equitable Group. This one went berserk. 5 months ago, it was worth $75, now is at $135. That's about an 80% gain. Another one would be CNQ. Canadian Natural Resources. For the past 6 months, it's gone up. 5 months ago, it was worth $21, now is at $35. That's like a 60% gain. So all this stuff right here, if I go back to the investment summary, and also another huge part is the US S&P 500 index. I got the VFB.TO right here, and over the past 5 months, it went up 10%. So for the blended average, let's say with the dividends and everything, well, I'm just gonna do a rough calculation here since the last video. I started with $369 and then we added $25,000 of our own money plus another $6K from dividends. That equals exactly $400K. So $400 to $453 is a blended average of 13% increase over the past 5 months. That's pretty good, right? And then there's the last factor. It's very minuscule in the very short term, but over the long run, this is the majority of the growth. If we look here, we see that there is a tab here called Dividend Reinvestment. So how does this work? Let's take Royal Bank for example. On February 24th, Royal Bank paid me $542, and on the same day, they bought 4 shares of Royal Bank at $111 for a total of $445. So this is the drip program that I keep talking about. Whenever they pay me dividends, I don't want money. I want more shares. And the reason why I want more shares is because once we have more shares, the next quarter payout, we'll get more dividends. So that's exactly like the chicken and the egg analogy I talked about in this video. Check it out. That's one of my most popular videos to demonstrate the snowball effect concept. And this dividend reinvestment only works when your dividends can cover an extra share. For example, if we look at Shaw Communications, they paid me $20 last week. But if we look at the share price of Shaw Communications, the share price is $22. So If we go back here, $22 is more than $20, so I can't accumulate an extra share. Another advantage of these drip programs is that you notice there is no commission being paid when I bought these extra shares. If we look at the Royal Bank, we bought 4 shares, price 0, gross 0, commission 0. Similar idea right here, Chartwell, we bought another 12 shares, commission 0. Let's look at one more, Vanguard High Dividend Yield Index, BDY. Bought 2 more shares, no commission. As I mentioned in this video, I hold many different stock accounts. And there's a reason and purpose for every single account. For this dividend growth portfolio, I have a couple of rules. If I can rename this account, I would just call it Black Hole Account. As I mentioned in the previous videos, there are a couple of conditions. As you can see here with this account, it's called Self-Directed Margin. I would rename it if I could. I would just rename it Black Hole Account. And there are several reasons for it. The number one reason is that things just go in and they'll never come out until the very end. The number one reason is that money just goes in and it never comes out until it reaches its destination or it fulfills its purpose. For this account, the main purpose is for it to get to $1 million. And then we'll consider to withdraw the dividends for different purposes. And the second criteria is that I'll only log in once every single month. And that's after I put the deposit in. That's the only time I log in and check the account. I don't care for the performance. If it was like how the Nasdaq performed over the last week and it dropped 10% over a course of 5 days, so be it. That's not the purpose of this account. The purpose is for increasing dividend payouts. That's the only metric we care about. If we go to investing.com and then we type in any of our holdings, let's say TD Bank, and then we go down here, go to financials, go down, dividends. Right here, we show more, and we see a steady increase in dividend payouts. Right here, back in 2017, for every share that you own, they pay you $2.20. But if we fast forward 4 years, January 2021, the dividend payouts is $3.16. $3.16. So if I just held on to my shares, my dividends payout went from $2.20 to $3.10. That's an increase of almost 50%. And that is the power of dividend growth. So at this rate, 4 years from now, in 2025, these dividend payouts would be $4.40, exactly double the $2.20 we had 4 years ago. So let's throw some real numbers in there. If we had 1,000 shares of TD 4 years ago, 1,000 shares times $2.20 is $2,200. If we held on to those shares until 2025, for every 1,000 shares you own, they are paying you $4,400 out of thin air. This is the power of dividend growth investing. We're looking for the dividend growth over time. That's the only metric we care about. Another one of my favorite dividend growth stocks is Fortis. If you go inside, same thing, financial, dividends, and click more and more. So right here in February of 2016, they paid out $1.50 of dividends for every single share. If we fast forward 5 years to 2021, they're paying $2.02 in dividends. This is approximately a 40% increase in dividend payouts. And the list goes on. If we look at Canadian utilities, same idea. Dividends, show more. So back in February of 2016, the dividend payouts was $1.30. Now is at $1.76. That's another 40% increase. This is the only metric we care about. And since most of the stocks that we picked are dividend aristocrat stocks, which means they have consistently increased the dividend payouts for the past 25 plus years, that is gold. We don't care about the share price fluctuations, we just care about the consistent dividend payouts. As I scan through the portfolio, many of these are considered medium to high dividend stocks, as in they pay more than 3.5% in dividends, but not all of them pays that. Some of them only pays 1.8, some are 2. So why are they in my portfolio? Let's go through a couple examples. For example, CNR, one of my favorite stocks to own. CNR. Okay, CNR right now they pay out a dividend of 1.8%. This is nothing. This is not considered a dividend stocks in most people's perspective. But if we look at the dividend payouts, 4 years ago it paid 1.65, now is 2.46. That's more than 50% increase. But that's not the main point. The main point is how well it performed over the years in capital appreciation. Right here, we see that this line is pretty much linear, straight up. If we go back 5 years, if we just go back, right now is at 140. If we go back to the date when it was $70, $70 right here, that was 2014. So 2014 to 2021, in 6.5 years, the stock price doubled. Using the rule of 72, we do some reverse calculation. Since the stock doubled in 7 years, 7 goes into 72 about 10 times. So on average, the stock grown 10% every single year. And on top of that, you get dividends, another 2%. So 12% every single year, capital appreciation plus dividends. Another one to highlight is Equitable Group. As we can see here, if we order by percent return, EQB has performed 129% for me. But if we look into the stock, this stock only pays 1.25%. We didn't buy this for the dividends, we bought it for the growth, or a hybrid of both. If we look at the financials again, dividends, increasing dividend payouts. 5 years ago, 84 cents, now is $1.48, almost double. But these are smaller positions, as we can see here. EQB only accounts for 6% of my portfolio, but something like TDs and the Royal Banks are at 12%. And there's several reasons for that, because EQB is a much smaller stock than TD. So for EQB, the market cap is only $2.28 billion. If we look at TD right here, the market cap is $141 billion. That's about 70 times the EQB. And the dividend yield is 4.19%. This is a true dividend aristocrat stock, not the EQBs, not the CNRs. But why do I have this in the same portfolio? It's because this portfolio is for Canadian stocks for me. I didn't want to open a new account for Canadian growth stocks. There is only a handful of them. And many of them I can just buy with my US accounts. So if we go back here, another two positions that's grown the most for me are the ETFs. The VUN, the Vanguard US Total Market, and the VFV, the Vanguard S&P 500 Index. For the VFV, it's grown 52%. For the VUN, it's at 34%. Both of these won't be considered dividend aristocrat stocks as well. It pays tiny dividends right here. Dividend yield 1.28% for VFV. And for VUN, the dividend yield is even less at 1.1%. So these stocks normally won't be considered for a dividend growth portfolio. Again, I do this because I kind of wanted a hybrid strategy for this Canadian dollar account. So until I get the account to maybe $1 million, and then I shift it back to pure dividend stocks. That pays out 4+%. But right now, as we just calculated, we're getting about 15,000 of dividends per year for this 450K account. So a blended average would be 3.33%. So that's why we kind of diversified. So that's the blended average. Some stocks like the CNR, the EQB, the Loblaws, the VFV, the VUNs, all of them are about 2%. But all the other ones, the TDs, the TELUS, the Bells, they blend average for 4.5. So I'm quite happy with this 3.33 dividend yield, especially when my strategy is kind of a hybrid between dividend growth and growth. Another condition to this account is that when things crash, you double down. Let's take a look at what happened last year. During the crash of 2020, we're going to date it back to February of 2020 before the crash, and we're going to see just the deposits. So right here, it shows a total of 19 deposits. But over the last year, there's only 12 months. So what's happening here? As we can see here, in March/April, we deposited an extra 7 times. 7 times. And it ranges from different amounts. So these are the extra deposits: 6,000, 1,000, 3,000, 10,000, 1,000, 3,000, 10,000. So in total, that's about 33K extra that I deposited on top of these regular deposits. As you can see here, the following months is all 5,000 deposits every single month: June, July, August, September. But here, this is where I found an opportunity to buy quality dividend stocks at low prices. If we go back to just the last year, this is what happened in 2020. In January of 2020, the Dow index was at 28,000, but in March, it's at 21,000 and change. So there was a huge drop for about 30%. So this was the ultimate bottom in March. But I started buying back in April because I saw that things weren't tanking anymore and the worst news seems to be behind us. So that's when I loaded back in, April 2020. And let's take a look at what I bought with this money. So right here, the Vanguard VDY, the High Dividend Yield Index, the CNRs of the world, I swiped those up at 110. And then Canadian Apartments, Loblaws, Rogers Communications, CNQ. CNQ was one of the bigger wins for me. As you can see here, I got them at a price of $18. And I bought them a couple of times. CNQ, $18. This one is at $23. Let's see. 23, 20 again, 20 again. And then it just kept buying. 21 and 21. Yeah, that's it. So I bought a total of like 5-6 times for CNQ. Let's take a look at how they performed. So this is CNQ. Right now it's at $35, paying a dividend of 4.66%. I believe when I bought it the first time at these levels at $19, the dividend yield was at like 7 to 8%. That is the only metric we care about for this dividend growth account. The lower the stock price, the higher the dividend yield. So when things crash, it's not a time to sell these dividend stocks. It's the other way around. So now we'll look at the different holdings here. As I mentioned in the previous videos, it's mainly concentrated in a couple of different sectors. Like the telecommunications here, we have the Bell, the Rogers, the Shaw, the TELUS. The banking, the financials, the TD, the Royal Bank, the Equitable Bank. The utilities, the Canadian Utilities, the Fortis, the resources, the CNQ, the REITs, the Canadian Apartments, and the Chartwell Retirements. All of those pay like a 4 or 5% yield, and we all need to live somewhere, right? And then we have these two, the VFV and VUN. I compared it in the last video that in the long run, either one of these are fine. I just get both for a better blended average. And VDY is a pretty good one if you don't want to think about anything. That's exactly what I've done. Sometimes you just don't want to pick any stocks and you just go in for the VDY because they're well diversed. Vanguard VDY. Okay, we're gonna go through this again. As we see here, you can just Google it. Vanguard Canadian High Dividend Yield Index, VDY. So if we scroll down and we see the holdings, we have a lot of financials, we have pipelines, more pipelines, banks, life insurance, telecommunications, fertilizers. So they're well diversified across for a total of 44 holdings. Some of these are minuscule, like 1%, who even cares, but the majority of them is under the banks. And currently, this VDY pays a good 4.35%. That's a whole 1% better than my portfolio because of my hybrid nature. Another point that I want to get through is that this portfolio is not get rich quick. It's a get rich eventually portfolio. Because the strategy here is that we're building snowballs. We're building many of these snowballs. And these snowballs takes time and effort to grow. Every quarter, they pay out dividends, we reinvest it so we get the snowball a little bit bigger. And every single month, we put in more money into this account. So all the snowball gets a little bit bigger, or we're just making new snowballs. That is the analogy for this whole account. We don't care about the stock price. We just care about the dividend payouts. So many of these holdings, there's no hope for it to double over the next year. Let's say for Fortis, it's pretty much flat. Let's say 1 year is actually gone down a little bit. But 5-year run is kind of flat. 5 years from $40 to $49 is only 20%. Now we look at the S&P index over the past 5 years. 5 years ago it was at 2,000, now it's at 4,000. This has almost doubled compared to just the 20% growth in Fortis. This S&P index has almost doubled over the past 5 years compared to the 20% growth in Fortis. It's a different game. This one we care about the dividend growth, and that's all it matters. Focus on that metric only. So I think that's a pretty good recap of this account as of February 25th, 2021. I think at this rate, if we deposit $5,000 every single month for the next 10 months, that's another $50K. So that'll reach a goal of $500,000. So hopefully in a matter of maybe 3 years, I can get this to $1 million. But we shall see. I'll update you guys. Comment down below if you like this type of content where I just talk about my thought process with these various accounts. I've seen some YouTubers that does these recaps every single week. I find that totally pointless. I'd rather just research some other things, some other plays, some other strategies, read a book than going through those videos every single week. All this stuff is so dry. It's a get rich eventually strategy. So why are we even focused on the short term? Short term, weeklies, I don't care. Last time I done the portfolio update was 5 months ago. And then before that, it was more than a year ago. So nothing really changes. So why am I wasting my time making these videos? Therefore, wasting your time to watch them. Again, that's just my 2 cents. Thanks for watching. Take care, and I'll see you in the next one.